Hi, I'm Shiloh Bates, and welcome to the CLO Investor Podcast. CLO stands for Collateralized Loan Obligations, which are securities backed by pools of leveraged loans. In this podcast, we discuss current news in the CLO industry, and I get to interview key market players. Today, I'm speaking with John Kim, CEO and co-founder of Reckner Capital. We talk about the new CLO ETFs that his firm has launched, which employ leverage from the repo market. Reckner also has launched reinvesting ETFs, the goal of which is to minimize the cash distributions to investors and have their return driven by an increasing share price. I'm always looking for interesting guests to have on the podcast. Email us at info@flatrockglobal.com if you'd like to come on. And if you're enjoying the podcast, please remember to share, like, and follow. And now, my conversation with John Kim. John, thanks so much for coming on the podcast. Good to see you.
Thanks, Shiloh. Good to see you, too. It's been a little while.
It has been a while. I think we first met about 15 years ago when you were a CLO banker in Edna, Texas. But why don't we go back even before that and talk about how you ended up being a CLO portfolio manager?
I guess it's been a little bit of a long road there, as it has been for you. So yeah, I did start on the sell side. I first started working in CLOs in the early 2000s. I was at CIBC, and I worked for our mutual friend, Ken Wormser, for a little while.
I think back then there would have been just a handful of CLO managers and maybe 2 investment banks in the business.
Exactly. Technically, our group was called asset securitization generally. It wasn't specifically for CLOs. We did all sorts of different types of securitizations. There was a whole ABS team. Dan Peterzak was in that group at that time. So this is going way back, somewhat ancient history. But CLOs were burgeoning. They weren't super common back then. But Ken was really one of those pretty visionary guys. I think he was at Citi before then, and he had his pick of where to go. And the bank is the legend there. And he said, well, I'm going to go to securitization. Everyone said, securitization? Why would you want to do that? So at that time, it was not a big market or a big field. But he correctly foresaw that that was going to grow. So he created a group around that at CIBC, of which I was a part. So that's where it started. And then pretty quickly after I joined CIBC, the entire team moved to what became Natixis. It's originally called CDC, French bank. And the French, as you know, were always more interested in securitization than the Americans in those days. They had a lot of graduates coming out of a particular French school that did a lot of derivatives training, mathematical approaches to the market. So securitization was a natural field for them to get involved in. And I started doing CLOs really, although today I guess they would be considered more like private ABF loan structures. They weren't technically CLOs, I guess, in certain areas, but we did a bunch of them starting in the early days at CDC. The loan market in those days was very bifurcated. There was clearly broadly syndicated, which was a growing market. There was the stuff that we did at what became Natixis, which was really off-market, more handmade deals. We did a first deal for Drawbridge, the Fortress credit arm. We did deals for Patriarch, which were distressed in nature. Hardcore structuring, very, very difficult deals to pull off, took a long time. So those were complex trades. And then about 3 years after I started there, I went over to Deutsche to run CLO structuring for them. And that was a whole different ballgame. It's more flow, BSL, lots of capital markets interface, which we didn't really have at Natixis, more standardized structures. And your job was really to push out as many as you could, obviously. But in those days, that was 2005, 6, 7. Those were the boom years for CLOs. Those were the days of negative basis trades for AAAs. You had L plus 25, 26 coupons on AAAs.
Bring it back.
Exactly. However, loans were L plus 195. So pick your poison. I remember that a few managers in those days struggled to get their weighted average spread above 200. And we were like, you have to hit 200, otherwise the math doesn't work. And they really struggled. There's not enough to buy. So Deutsche up until the crisis, and then all hell broke loose, as you know. And then I returned to Natixis in 12 and was there for a couple of years, but then eventually went to the buy side to an insurance company called Security Benefit. And my team, that's when we started really tranche investing, doing a lot of buy-side structures to provide good yield to the insurance company on a good reg cap basis. So again, hardcore structuring, lots of trading, and our book grew to be pretty large. At the end, it was 14-ish billion of structured credit assets. So just learned over the years, took the sell side knowledge and tried to apply that to what we were doing in the portfolios.
And you also bought CLO managers while you were there.
We started CBAM. Those guys started in 2015 and got out of the gates very, very quickly. So it was interesting to work on those deals. We were called the affiliated structuring arm of that company. So we helped them get out into the market. They did all the loan management. Very successful program. They got to 15, 16 billion in AUM, and then they were sold to Carlyle. So successful trade. Those guys did a very good job, and it was interesting being on the issuer side for the first time. We had not done that as a team before. At the same time, we were still buying a lot of third-party equity, creating deals for ourselves. We had a pretty big equity book, about 3 billion, and all of the control deals that we did in CLOs were really structured by our own team. We didn't rely on banks for structuring. We came up with various new structures that the market hadn't seen. I think you're familiar with some of them. Highly levered private credit deals, some innovative stuff in BSL land. A lot of those created by our in-house guy, Ricky Lee, who you know also. And Ricky's top-notch structuring mind and creative. So he was able to solve problems on the fly in the market and figure out ways to make the returns better for the same products.
So have you enjoyed more working on the buy side of CLOs versus the sell side?
And I think everyone wants to get on the buy side eventually. If you're in our field, taking risk and living with that risk that you have hopefully structured for yourself is really very, very interesting intellectual exercise. It is different, clearly, from creating something and selling it. But what I never really liked about the sell side is you go from one deal, you sell it, you move on, you're doing the same deal again, most likely different group of individuals maybe, but the structure is very similar. There's not a lot of room for innovation or invention because you're very limited to what you sold last week because you have the same buyer base there. And you shouldn't just be buying the same thing over and over. And I don't think any real investor in our field does that. They're not automatons, they're not lemmings. They're really trying to find, can I create some alpha for my investor base? So if you're doing that on the buy side, clearly very interesting job. It's fun. And if you can make things go your way through structure and otherwise, then that's an added bonus.
I agree. I think it is definitely fun being on the buy side. So you recently joined a new firm. What was the opportunity that you saw there?
We got a new partner, Redbird Capital Partners. They are a $14 billion PE firm. They do have a significant part of their business allocated to FIG. So they're not newbies in credit, but they did not have a dedicated credit arm that was owned by their GP. So we partnered with them to create that credit arm. We're owned by the company itself, not a portfolio company in one of their funds. So it's a little bit of a different strategy for them to build it semi-in-house. It's a great opportunity for us to build a real broad scoped credit manager from the ground up and to do it in the way that we thought was really the most sustainable and scalable way. That's what we've been working on for the last year and a half or so. They've been great partners. They're very, very knowledgeable about our area. So that really helps a lot. We're not explaining credit concepts to them or having to walk them through the basics of our deals. They get it, and they're pretty quick to learn what they haven't seen before. They're very involved in insurance trades, reg cap stuff. So they're very sophisticated, and we just appreciate that partnership because it allows us to move forward in some of these areas which have not really been addressed before and to continue to try to innovate in the market without having a parent say, whoa, what are you doing? I don't get it. You have to explain this to me. And we're very aligned with that. So we feel very lucky to have landed here.
So is what you're building, is it primarily CLOs? You mentioned regulatory capital trades for insurance companies. So CLOs and CLO adjacent, or do you have plans beyond that?
So it's a little bit broader than just CLOs, although CLOs are going to remain a pretty big part of what we do no matter what. We have good capital markets interface for bonds. We know how to invest in equity. We can talk about the equity markets in a bit and probably why we're not super interested in them today, but the bond market clearly is a mainstay for us. But the goal here is not to build a CLO tranche investor. I think we realize now, and you know this, that market is fairly mature. There may not be tons of alpha left in that market.
This is CLO AAA to down to double B.
CLO bonds, we love it. It's great. It still has a positive delta to corporates. We all know the performance track record of CLO bonds, just really miraculous almost in terms of the rating levels versus the losses. But it's a crowded market now. When we started doing this in 2015 or so as a team, it was not as crowded. You had arb opportunities, you had ability to scale stuff, create a little bit more of a crafted portfolio. And now really the market has become pretty mainstream in many ways. I would say not a lot of ways to distinguish yourself from the market, or not as many, let's say. Even though we still find a ton of value in CLO bonds, and let's say that you're in corporates today and you're in treasuries and you haven't heard of CLOs or you haven't moved into structured credit at all, you're going to pick up a bunch of great risk-adjusted yield compared to what you're doing today. So for certain investors, it's still really, really important to provide those services to them. But for others who are sophisticated, already looking for a bunch of alpha in structured credit and elsewhere, look, it's part of your portfolio, but it's not the focus anymore because there are other things to be doing in private credit land, ABF land, NAV loans, CFOs, other things that people are looking at that have similar types of value propositions and might even be better. So depends on your poison and what your hurdle rate is, et cetera, and then how do you want to approach the market.
So what are the first products that you guys have launched?
So we're thinking about it a little bit as who are the buyer bases for what we're trying to process. We've got, on the one hand, sophisticated insurance companies for whom we're doing pretty bespoke portfolios in SMA format. They have very specific hurdle rate, reg cap parameters, other types of things that they need in terms of diversification and yield. So we will go and structure something very bespoke for those clients. Could be on a large scale or on a smaller scale. But the point there is that it's not necessarily a replicatable portfolio. We have to go out and find the right way to do it for that particular client, depending on the parameters. And then we've got a bunch of people who are, I need senior exposure. I'm a UK insurance company, for example. My portfolio is yielding 2 to 3. I'd like to pick up something that's in the 4s, has a 4 handle on it. Okay, that's easy to do. We construct that. And those are large scale SMAs, low volume fees, obviously. But for those clients, again, really huge value add because they can pick up 100, 150 basis points without really doing much work just by switching or converting some of their portfolio into structured credit assets. And then we have what we would call the individual investor arm. So we're trying to bring some of these asset classes to the retail market, as many of our competitors are, the flavor of the month and the year. We're doing that primarily right now in ETF format. So we tried to be innovative about it because we don't want to issue the 18th AAA CLO ETF. So we did issue like the 8th or 9th, but there's a twist. We have one turn of repo leverage in there. So if you're an institutional investor like you can go out and get 8 turns of leverage on a AAA portfolio from a bank in repo form. We put 1 turn of leverage into this fund to make it a very, very safe amount of leverage for a retail product. But still, we're picking up what we hope to be 40 to 50 basis points of excess yield over the unlevered competitors. So if you sort the AAA funds in the market today by yield, we will be the highest right now on an SEC yield basis. So we're hoping people will notice that and understand that the leverage embedded in our structure is really, really low relative to what the solidity of the asset class is. And then we have a mezz fund, triple B, double B. We skew more heavily to double B than our competitors. We want to pick up that excess yield, and our thesis there is that a double B really performs like a single layer better in terms of actual impairment and loss over time. So you should pick up those extra pennies in the yield, and you should attack that part of the capital stack and not be shy about it. So our fund tries to reflect that. And then on top of that, I don't know if you saw it, Shiloh, but last week we issued some new funds that sit on top of our AAA and our mezz funds. And Two of them in particular I'll talk about because they have tax consequences. They're both reinvesting versions of our core funds. So our core fund, AAA fund, is called RAAA. We released a fund that holds shares of RAAA. It is called RAAR, and the last R stands for reinvesting. And the goal of that fund is to basically minimize your actual cash dividends. Whereas our AAA has a monthly dividend like all of our competitors, and you get that in cash. Our RAAR will have a very minimal cash distribution, if any. So the idea there is that you're just reinvesting all of your dividends and it's accreting in your NAV. So if you are a US taxpayer, and this is not tax advice or investment advice, but if you are a US taxpayer and you hold a stock that is accreting in NAV and price, and you could hold that for more than a year, you should be able to claim a better cap gains rate as opposed to an income rate because you have not received any cash during that time frame. Similarly, for our MEZ fund, our CLO, which is triple B and double B CLO bonds, we created our CLR to sit on top of that. That's also a reinvesting fund. So look, if you're an RIA for your clients, you're very tax sensitive, you need yield. You don't want to bet the farm on stocks right now because it's so volatile. You don't want to be in corporates because they're moving around because rate vol is really, really high. We would say CLOs are a great place for you to be, number one. But number two, further, you should consider these non-dividending funds, these reinvesting funds, because they could potentially add a lot of after-tax income.
So in our AAA, so this is, I imagine it's broadly syndicated loan AAAs and done with a turn of leverage to increase returns. I guess I thought of the regulatory debt cap for 40 Act funds as being, you can basically borrow 33% of assets. That's how I understood it. Is repo, is that done differently or?
No, ETFs can actually have one turn of leverage. So they're not subject to the same rule as the 40 Act interval fund, for example. That's the ultimate limit for an ETF structure. We're obviously below that limit. You can't cross the line, but there are VAR calculations that you do on a daily basis to make sure you're not exceeding.
The VAR being the value at risk.
Value at risk, correct.
And so what would you say to somebody who comes to you and says, hey, should I buy our AAAs on leverage or just move down the stack to AA or single A without leverage? How should somebody think about that relationship?
Look, the AAA story is well known, and a lot of people just love the security of that. The price movement is clearly less volatile than the bottom of the stack. If price stability is very important to you, ultimate liquidity is very important to you, and you're willing to give up something in yield for that, that's a really good choice. We're running about 540 in yield right now for that product on an SEC yield basis. I say SEC yield because that's the only way to compare funds apples to apples, because everyone has different calculations for distribution yield. But if you have a longer term view, you want the excess yield. Our CLO fund is yielding a little under 7. It's going to be a higher yield than you can get elsewhere. There will be a little more price fall, but ultimately we don't think people get impaired. We think that you're really trading more on credit spreads than anything else. And over time, we think you should make a consistently higher yield without really running any risk, really, of losing a lot of principal during that time frame. So it's a little bit your risk sensitivity and your timing. If you have a long-term view, I think either can be appropriate, but I would say pick up the higher yield, because if you have a longer-term time frame, you can make another 1.5, 2 points annualized. And then maybe on an after-tax basis with the reinvesting fund a little bit better than that. You're supposed to do that. You're supposed to compound at a higher rate if you can. But a lot of people need liquidity, so they want the AAA for the safety.
Are you guys the first firm to figure out this reinvesting structure where instead of investors receiving ordinary income from our AAA, they're receiving or should receive, like you said, with your disclaimer that it should be more long-term cap gains instead of ordinary income, which would be obviously much more favorable for most folks?
So we are the first ones to figure it out in the CLO ETF landscape. There are other funds out there that do similar types of strategies to minimize dividend, but they are, generally speaking, funds that do it on behalf of other third-party ETFs. So the problem with that is, let's just say I'm going to do a reinvesting fund and I'm going to take your ETF. and I'm going to take someone else's ETF and a third ETF and combine them together. Well, your ETFs all have a monthly dividend. And then if there's 3 funds, there's going to be 36 monthly dividends, which means I have to do a tax minimization trade 36 times a year. It's really expensive to do that. It's not expensive per trade, but it adds up quickly. The benefit of our structure is that we are really referencing our own fund. So the reinvesting fund really references the core portfolio. It's the same exposure from an asset perspective that you would get in the core portfolio. The only difference is that, one time a year, we'll sort of do this dividend minimization trade. And since it's only one time a year because it's our own fund, we're able to keep the cost down. So let's put that in perspective. If you're paying 30 basis points of fee for our AAA fund, you'll pay 40 for the reinvesting fund. And that 10 extra basis points is really just admin. It's not an additional management fee or anything like that. It's just the cost of administering the other fund. So what you're getting for that 10 basis points is now potentially a really, really high reduction on your federal tax rate. Similarly, for the RCLR fund, you're paying 10 basis points more than you would pay for the core fund. So it really allows you to choose what you want. Some people want the income. Some people want to get monthly cash. They might be spending it or putting it into another investment, spreading out their bets. But some people are just like, well, I just want the best after-tax outcome. One of the common things we heard in our early days when we started these funds, a lot of people asked us, well, after-tax wise, shouldn't I rather be in a muni? And fair question. If you live in New York and you buy a New York muni, you might be better off buying that as opposed to a CLO AAA bond. But now with this reinvesting structure, I would say no. I don't think you're actually better off buying a muni. First of all, it's a triple B area bond. You might be getting paid a little bit more after tax, but you're taking a lot more risk in our opinion. So suddenly with RAAR, you're a lot more competitive on that front. So we're trying to make it a little bit easier for people to choose their dividend frequency and manage their gains a little bit easier and the timing of that a little bit easier.
Is the reinvesting fund, is it structured as an ETF?
Yes, they're all ETFs, all daily liquidity funds.
So then in terms of your investment selection, do you like private credit debt in your funds, or does it lack the liquidity that an ETF might require?
We do like private credit CLO debt a lot, but not for these funds, because these funds are daily liquidity. And not only are they daily liquidity, they need to have less price volatility than the market average. So what we do in these particular ETFs is to try to stick to tier 1 managers that have a fair number of bonds outstanding and a fair amount of money outstanding in bond issuance. And also, from what we can tell from our cap markets desk, high bid depth. It's very important to have 8 bidders for your bond if you're trying to sell it rather than 2. So that's been a strategy we've had ever since we started managing CLO ETFs. We have not strayed down into tier 2 or tier 3 managers. This is all subjective ranking, but we have tried to stick to what we believe are tier 1 managers. And the way that we define a tier 1 manager really has to do with how many people are going to show up if you're selling that bond tomorrow. So for that reason, private credit, although I think it's attractive as a standalone product, it's just not appropriate for this particular wrapper, because we do operate on the theory that 20, 40, 60% of your fund could go away tomorrow. People can pull their money very fast in ETFs, and you have to be able to sell. And when we sell, we want our marks from the previous day to reflect what we're going to get the day that we have to sell. There shouldn't be much of a delta there unless the market is super volatile. So we want people to be able to rely on our NAV. We want our NAV to move less than our competitors. We want to be stable, because over the longer term, I think that's very important to that particular buyer base.
So in the investments that you guys manage today, is it all AAA to BB, or do you guys own some equity as well?
We have not done any equity for a while, and I think there's 2 reasons for that. The first reason is the equity returns that we are modeling out for new issue deals is pretty anemic. I think the biggest problem that is quite obvious to CLO practitioners is that loans are too expensive and loan supply is very depressed. So you don't have enough choice in the loan market, and therefore there's not a lot of price ranges. A lot of stuff is trading at 99 to above par. So if you're a CLO manager and you're originating a new portfolio right now, you're definitely going to be paying high 98s and up. So there's not a lot of room for alpha generation. There's not a lot of room for upside. even if everything pays off at par and you make no mistakes and you have zero defaults in your portfolio, you're not really making that much on the upside. You haven't originated at a low enough price to make the equity very valuable. And we think that that is one of the most important, if not the determining factor for long-term equity returns, is that price where you originate your initial portfolio. If you originated at 94, 95, you have a really good chance of making a lot of money. You can model a lot of defaults in that, and that structure will withstand a lot more because of your price cushion. But if you're buying stuff at 99, not a lot of room for error. The second reason that we haven't done a lot is because a lot of managers have now raised captive funds. And I'm sure this is a discussion that you've had before with other people, but we have mixed feelings on captive funds.
I don't have mixed feelings,
I can imagine.
but I'd love to hear your thoughts.
I think our view is captive funds have one really good positive thing for investors in them, which is one layer fees. You pay the CLO manager directly. In almost every other instance, if you're buying a closed-end fund or another fund, you have to pay sort of a dual layer of fees. That's not great for the investor. But the problem with a captive fund, as I'm sure you'll agree with me here, is that the manager doesn't have an incentive to not print a deal. So you've got a captive fund, your XYZ manager, the returns might not model out to something great, but you are still somewhat incentivized to print that deal, even if you can source the loans. And you're not necessarily trying to time the market well enough. If you tried to time the market and you have to wait 6 or 8 months to time the market properly, you're probably not going to do that in a captive fund. You've got to deploy the money when you have it. You make fees when you deploy the money, not before you deploy the money. And you've got a loan team there that's being paid to like buy loans. They go out and buy loans. So we find that the return profile of some of these captive funds we think is going to be pretty weak going forward, but they have taken over the market. So we are not finding enough opportunity. There are some really great managers out there that we would love to work with right now and bring capital to, but they've told us, well, we've got a captive fund and we've got to deploy that money before we can talk about third party money.
So on your first reason to not own equity, the initial projected returns aren't that great. And part of that is just that the loans are available at par and you want to buy them at discounts. But what about the secondary? I mean, the secondary trades at levels that are totally disconnected from primary, and any secondary buyer who's like a true third party is going to price the investments out to probably like a mid-teen return or something like that. So why not consider the secondary?
We do consider it, and I think you're right to say there is more value there. We look every single day at the equity lists. We price everything out. And I would say that out of the, call it 50-ish bonds that are offered over the course of a week, we're probably interested in like 2 or 3. And there's a few things we're sorting for. It's not just the IRR model. It's really the tail in the portfolio. How much exposure do they have certain sectors that we think are not going to perform as well as others? So when we price it out, there are a few bonds here and there, I would say, that we like. We could probably put to work 20 or 25 million a week or something like that. But it's not anywhere close to a scalable, big investment portfolio stuff because it's just not available in enough quantity for us to be that interested. The second thing I think that's really the problem with secondary is you're almost never getting control position in the secondary, very rarely. So we like control because our expertise, part of what we think we bring to the table is to be able to really know when to restructure deals and when to refinance them and remarket them and when to extend them and when not. So you can't do any of that if you're a $5 million out of a $50 million tranche buyer. So we don't love that. It doesn't mean we won't do it, but we would prefer to have control positions and do things in the primary if we could. So it'd be a heavy preference. But I take your point. We do find value in the secondary, and I think there's some very interesting bonds out there occasionally that we would like to pick up.
On your point about the risk retention funds, I mean, I guess captive funds is how we described it, but I think they're unfortunately a problem in a whole bunch of different dimensions. I mean, you mentioned that there's too much demand for loans because the captives are forming CLOs that probably shouldn't be formed. But then the other part of that is just on the financing side. So there's just CLO financing rates should contract more than they have. And that's because every time they contract a little, they're met with increased demand. And look, do I care if people buy primary equity at very low projected IRRs? I don't think so, because they're my competitors. So it's like, well, we're all competing on a track record, right? But how what they're doing affects me is that their demand for loans and their demand for CLO financing affects the entire $1.1 trillion market. It's not just what they're doing to themselves. Unfortunately, it negatively affects all of us, is my view. I think it's great if you're a debt buyer, which is, I guess, your focus now. I mean, it's probably pretty good because lots of CLOs are forming. You're not in it for the equity returns. And if the debt price is wide, it's probably fine by you. I think it's more of like a equity problem, I'd say.
It is an equity problem. You're right to say that it filters through to the entire market. So yeah, they're all correlated and related. And it used to be in the old days, if you couldn't make the returns work, you just didn't print. That was really your choice. You didn't have this option to just sort of go ahead and print anyway. But I think some CLO managers, not all, but some CLO managers have definitely done their investors a disservice by showing them unrealistic models. When we run a basic model, like a standard 270 model that anyone can run an index, and you see a 7% return or 6% IRR expectation, I mean, that's really low. You're not supposed to necessarily invest in that. And then you see the same deal modeled up with a refi assumption here, an extension assumption there, and we're going to buy loans cheaper by 2 points in a year, and you get to a 12. We just think that's not realistic. You're making a lot of assumptions there. And it might be that some of them come true, but what they're really doing is promising their investors that one or more of these things is going to go their way. And that's just not going to happen for everyone. It's going to be a tough road for some of these deals to hit the hurdles that they're promising their investor base.
So one of the new risks in the market that people are talking about quite a bit is just exposure to software loans, which are around 10% of CLOs. And there's other maybe industry categories that maybe you could add on top if you wanted to be more pessimistic. As you talk to CLO managers, how are they thinking about the risk in these software loans?
Well, I think the first thing that we notice is a lot of people sold first and asked questions later. There's a lot of momentum trading going on in the loan market, like the equity market now. There's a shiver in the market somewhere and people just dump it. And there's a lot of loan funds out there and a lot of BDCs and other types of loan buyers that are soaking up that demand pretty instantly. So a lot of CLO managers just shot first and asked questions later. The other thing I think that's interesting is you say it's 10% of the market, and that's true. That's the percentage that people throw around. But there's a lot of stuff that's classified elsewhere in CLOs that's probably still software that's classified somewhat differently. So we think the true percentage is probably closer to 15. So it's a pretty significant part of the market, could be more significant than people think because, for example, you might have healthcare software company and you might classify that as healthcare. It is healthcare, but it's also software. It's going to be subject to some of the same concerns that the SaaS providers are under right now. I think that some of our CLO managers have just tried to figure out, okay, am I just going to be early and then I'm going to try to rebuy cheaper? And some of them have done that successfully. Some of them are really trying to figure out what is actually going on. Software industry, as you know, for a long time, it's never been a high growth industry. It's been a slow escalator industry. But the great thing about it is it's very embedded industry. You get a client for SaaS software, it is really hard to change software. You are probably still there for the long term. Does this mean that over time, I don't know what the time frame is it 1 year, 5 year, 10 years? Does this mean over time that people are going to be able to jettison their SaaS software and replace it with AI bots that are 10 times cheaper? I think clearly that is the goal. That's where we're heading. But we could not do that today. I mean, we're a relatively small shop, but we use all sorts of investment software and tracking software. And the thought of ripping that out today is clearly crazy. Can't do it.
There's a number of software providers that we pay for, and we don't sit around every month going, oh, should we renew this and retrain our entire firm on a different system that somebody lab coded on the weekend? That's certainly not what we're spending our time doing.
Exactly. And look, I mean, just from where we sit, I don't know how quick that's going to be. If you look at our investment software, for example, and just booking assets, we have software that in theory, we could do 17,000, 20,000 line items. A whole bunch of information has to go around those line items. I mean, yes, in theory, we can do it cheaper over time. But where we stand today, we're going to have 9,000 line items loaded in this system. Can't just pull that out overnight. That's a longer term process. And you have to test software and make sure that you're still compliant, right? And that's not easy. So if that's the case for a small firm like ours, and you're a very large firm that has multiple systems interacting with each other, I just don't think it's going to be as quick as people think to, to have AI come in and wash it away. So it feels like an overblown concern. There was a lot of AI noise around a whole bunch of different industries. Software is clearly one of the ones that will be affected. But in the short term, you have a 3-year, 4-year exposure to a leveraged loan to a SaaS company. I mean, I think you're probably going to be fine. I think it's going to pay off at par if the company is solvent and functioning, which most of these are. So it might just be a good opportunity for people to pick up loan at 94, 95 instead of 99, and then take their chances on the timing.
Some of our CLO managers have had that view that they're like, listen, we're levered 4.5 or 5.5 times, and maybe these businesses were worth mid-teens last year, and now maybe it's like low double digits or something, but it's an issue for the equity when they look to sell the company, but it's probably not, going to affect the loan. And then the other part of it is, AI, I think, made a significant jump in terms of performance at the beginning of the year, but AI risk is something people have been thinking about for a long time. So every software loan at a CLO manager, and people have been thinking about this risk for a long time.
They're not distressed. No one's claiming that these companies are about to go out of business tomorrow. Look, the market should react to longer term views. There should be price adjustment and rethinking, and there should be some adjustments, as you say, to the value of these companies, probably in the equity markets. But from a loan perspective, yeah, I agree with you. They're far from being distressed, and I think they should work out fine in the short term.
John, is there anything happening in our industry that we haven't touched on today?
Happening in our industry? Well, broad question. There's nothing and a lot. The industry's mature, growing. I do like to be able to tell non-CLO people that we're $1.3 trillion or whatever the global outstanding is, because what is it? The third largest credit market now after loans or high yield or mortgages, I guess, maybe fourth. But it's also one of the more liquid ones. From a liquidity standpoint, I think in the 10 years or so that we've been trading bonds, it is so much more liquid today than it ever was. There's just a lot of new participants. So look, I mean, when you and I started in this business, 90% of people had not heard of our product, didn't know what CLO stood for, and now it's firmly embedded in many people's PAs. Just something that I'm not sure either of us would have predicted back 20 years ago, whatever. So it's come a long way. It's a very interesting development. And having been in the market from the early days when it was really still a handmade product, to seeing it become like a real cap markets flow product is super interesting, right? I don't think many people have had that experience, because most of the markets that we think about as really flow have been around for a lot longer and developed not over the last 20 years, but over the last 40 or 50 years. So it has definitely been interesting. I think CLOs are a lot more mainstream than we want to admit now, but they're still complex enough that there's a decent amount of education to be done, especially with certain classes of investors, like maybe Euro insurance companies who've been a little prohibited from buying them in the past, so haven't paid any attention to them. And now capitals are changing pretty significantly there. So it's going to be a hot asset for them going forward. And they're trying to get a lot of education on it now. So we're going to still continue to see, I think, a lot of growth and demand for CLOs. Look, I think it's going to keep pace with high yield and loans at this point.
So John, if you had to describe a CLO to somebody outside of our market and you only had 30 seconds, how would you do it?
It's a segregated bank that makes loans, issues bonds, and has equity shareholders. And the great thing about this bank is when loans go bad, you cut off the dividends to the equity and you make more loans with the dividends. And that's why the bonds are really safe.
John, thanks so much for coming on the podcast. Really enjoyed it.
Thanks, Shiloh. Good to see you.
All statements of opinion or forward-looking statements herein are based on current market conditions and should not be construed as guaranteed as future events, and are subject to change at any time without notice. The content here is for informational purposes only and should not be taken as legal, business, tax, or investment advice, or be used to evaluate any investment or security. This podcast is not directed at any investment or potential investors in any FlatRock Global fund. For definitions of words used in this podcast, please go to flatrockglobal.com/glossary. Risks. CLOs are subject to market fluctuations. Every investment has specific risks, which can significantly increase under unusual market conditions. The structure and guidelines of CLOs can vary deal to deal, so factors such as leverage, portfolio testing, callability, and subordination can all influence risks associated with a particular deal. Third-party risk is counterparties involved: the manager, trustees, custodians, lawyers, accountants, and rating agencies. There may be limited liquidity in the secondary market. CLOs have average lives that are typically shorter than the stated maturity. Tranches can be called early after the non-call period has lapsed. ETF risk. Disclosure. ETFs are subject to market risk, including the potential loss of principal, and may trade at premiums or discounts to NAV. General disclaimer section. FlatRock may invest in CLOs managed by podcast guests. However, the views expressed in this podcast are those of the guest and do not necessarily reflect the views of FlatRock or its affiliates. Any return projections discussed by podcast guests do not reflect FlatRock's views or expectations. This is not a recommendation for any action, and all listeners should consider these projections as hypothetical and subject to significant risks. References to interest rate moves are based on Bloomberg data. Any mentions of specific companies are for reference purposes only and are not meant to describe the investment merits of, or potential or actual portfolio changes related to securities of those companies, unless otherwise noted. All discussions are based on US markets and US monetary and fiscal policies. Market forecasts and projections are based on current market conditions and are subject to change without notice. Projections should not be considered a guarantee. The views and opinions expressed by the FlatRock Global speaker are those of the speaker as of the date of the broadcast, and do not necessarily represent the views of the firm as a whole. Any such views are subject to change at any time based upon market or other conditions, and FlatRock Global disclaims any responsibility to update such views. This material is not intended to be relied upon as a forecast, research, or investment advice. It is not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy. Neither FlatRock Global nor the FlatRock Global speaker can be responsible for any direct or incidental loss incurred by applying any of the information offered. None of the information provided should be regarded as a suggestion to engage in, or refrain from, any investment-related course of action, as neither FlatRock Global nor its affiliates are undertaking to provide impartial investment advice, act as an impartial advisor, or give advice in a fiduciary capacity. Additional information about this podcast, along with an edited transcript, may be obtained by visiting flatrockglobal.com.